Hello and welcome everybody to our quarterly eToro Popular Investors Call, which we do every quarter. And we're lucky today to be joined by a really great panel of guests where we can talk about all things that are happening in the market. It's a very interesting time, as you all know, at the moment with what's happening in the market. But we hope to kind of provide some color and some discussions around some of the key market talking points at the moment. So without further ado, we introduce you to our special guests and also to another one of our key regular panel members, 𝗲𝗲𝗍. So just to get started, I want to introduce you first of all to 𝗍𝗶𝗃𝗃𝗏, and he's one of the most copied popular investors on eToro. Jeppe, if you could just introduce yourself briefly. Thank you.
Yes, hello everyone. Yeah, so I've been trading on eToro since 2013. So next year will be my 10-year anniversary, and I'm the most copied popular investor on eToro, with more than 20,000 copiers and 500,000 followers and $50 million in assets copying my portfolio. And since 2013, it's been a 25% average annual return on investments. I focus on fundamental analysis, so analyzing what companies are really worth. I have a background in finance as a management consultant, helping large banks, mainly from London. I'm originally from Denmark, now based in Dubai. And yeah, since it's been going well on eToro, I've hired a few people to help me out as well, to sort of, yeah, free up my own time to do the things that I think are most value creating.
Great. Thank you, Jeppe, and congratulations on your 10-year anniversary on eToro. Okay, and over to Heloise. If you could introduce yourself, that would be great.
Yeah, hi everyone. I'm 𝗲𝗏𝗏 Greeff. I've been on eToro since 2016, and I've been a popular investor for most of that time. I have just over 15,000 copiers and 175,000 followers. My strategy is a long-term equity portfolio, and I have a background in machine learning and AI. I used to work as a research fellow at the University of Oxford. I've recently become a full-time popular investor, and so I use a lot of data-driven analytics and bespoke algorithms as part of my analysis, along with fundamentals.
Amazing. Thank you, Heloise, and congratulations on going full-time. It's a big commitment.
Yeah.
And over to you, 𝗲𝗲𝗍. Some of our regular listeners will know about you, but if you could just introduce yourself, that would be great.
Sure. So I actually opened my eToro account earlier than Jeppe in 2012. But at that time, I knew nothing about the markets. I was just copy trading others. It was about 2015 or 2016 that I got serious about the markets. I started researching into companies. In general, my portfolio is a collection of high-quality companies which have competitive advantages, or what we call moats. I try to run a more concentrated portfolio, so it can be more volatile, but when the market is doing well, it can also produce better returns. So in 2019, I started my YouTube channel where I was sharing how I was investing my own money and my own life savings. Later that year, towards the end of 2019, I became a popular investor. So I started sharing my portfolio on eToro. The name of my YouTube channel is Investing Education. I work as a lawyer, and I hope to be a full-time investor like Heloise and Jeppe one day.
Awesome. Thank you very much, 𝗲𝗲𝗍. And I'll just briefly introduce myself as well. My name is Stephen, and my eToro username is 𝗍𝗶𝗍𝗍. I'm a macro investor, and I look at what's happening all over in the macro picture. And I like to invest in a number of different sectors. And I like to look for companies that are potentially undervalued, a kind of a long-term investor. So, okay, thank you very much for your introductions, and we'll get onto our main topics of discussion today. I just wanted to start off because I know that the last quarter and actually 2022 has been difficult for the majority of market participants this year with what's been going on in the markets. So I just thought I would talk about some of those key things that happened in the last quarter as kind of as a wrap up of what happened in quarter 3. And then we can delve into some key points surrounding that. So I'll get started, I think, with Jeppe. Was there any key aspects within the last quarter in your portfolio that you think particularly drove it? Do you think that there was kind of issues with the inflation, potential recession, and also interest rates? What do you think most drove the equities either positively or negatively in your portfolio? I
think you got the order right in saying those words, because the absolute key there was inflation, because a lot of the other things are responses to inflation. So you're raising interest rates because of inflation. So it's sort of, yeah, that's also important to talk about, but it's always good to find out what is the one thing underneath all the others. If you find a company as well and there's 12 problems and you ask different people and they all complain about IT, you don't actually have 12 problems. You have a bad IT part of the business. Similarly here, if you're seeing issues everywhere and all of them sort of ties back to inflation, that's really the core bit. And with inflation, I think we've also been sort of, one thing is having too high inflation, but then you could say we could also be expecting to have too high inflation. But time and time again, we sort of have inflation surprises. And, there's sort of like, now third time we get a negative inflation surprise, everybody sort of got to upwards adjust what kind of surprise. If you're surprised 3 times in a row, you're like, I'd rather now get surprised on the other side by sort of upwards adjusting my expectation, rather than keep, because clearly something's wrong in our general, take the average of all the ways economists try to predict inflation. If you're surprised in the same direction 3 times in a row, you should sort of expect there's something that we are not capturing with our models here. We don't know exactly what it is, or maybe we are capturing it, but we have, but for whatever reason, if you keep getting surprised in the same direction, then there is something that's sort of, it could be of, it could just be bad luck or whatever, but it's certainly a hypothesis that's something wrong. And that, then when you have sort of a response to that in terms of increasing interest rates, also more than, the speed of interest rate increases being more than what would have probably been expected based off of the ways that central banks have historically dealt with too high inflation, that sort of hurts certain businesses more than others, and that sort of, as one would have expected, has been reflected in how the markets have reacted. And then if you look for the sort of difference between the full year versus the quarter, the big sort of a difference has been in terms of that energy prices were going up a lot in the beginning, but in this quarter they've sort of come a little bit down again. And if you then look at sort of the energy companies as an investment in general, I think that they sort of, they're not just, the amazing response to all of that. They're sort of, their price have been going up a lot as well. So even if you might have longer term higher prices, you're also paying slightly more for those companies. So they're not sort of, they haven't been, they're not now sort of a great solution for that.
Do you think that we might potentially have a scenario at the moment where inflation might have already peaked? And do you expect inflation to go down significantly in the next couple of quarters?
So I think that if you can sort of do some different steps. One is sort of everybody, in terms of what they're saying and writing in the news, whatnot, say that inflation is going to be very high for very long. Yeah. Then you got the markets, what can you actually trade on? Because you don't have to take inflation as some random thing that's going to happen. You can log in, in the same way that you can insure yourself against something, you can insure yourself against inflation. You can right now buy basically through swaps or through inflation protection or in other ways. You can log in. So if you disagree with the market's view on inflation, you can trade on that. You can say, okay, I can on a 30-year inflation protected bond get this. I can on a 10-year get this. I can on a 5-year get this. So if you disagree that the 5-year inflation rate is going to be drastically different from 3.5%, well, you can log in, beta neutral trade on that and capture that difference. So I think all else equal, we have to accept that the market is right on this. And the market's saying that over the next 5 years, 10 years, and 30 years, we're going to not have inflation like we had in the last quarters. But then we've been surprised for some months and quarters in a row. So it could be we'll be sort of seeing something slightly higher in the market. But I don't think if you look at the total growth of the money supply, which is sort of that's the real tidal wave that's hard to come with, if all oil producers can come together and cartelize, they can drive up prices. If everybody unionize and they agree, we're going to have a higher wage, then that can drive up a certain price. But there's there's a limit to how much you can really negotiate over these prices just from natural market forces. The one that you cannot really negotiate with long term is the money supply, which is a part of component that is the total debt supply. How large is the balance sheet of the central banks? How large are the balance sheets of the commercial banks? And that started declining at the start of the year, but that works with a delay. Usually you see the big actions and central banks can have, before they sort of come into the economy, it can take like maybe not 2 years, but almost 2 years. And that's simply through effectively what is called sticky prices. If you own a restaurant, you're not going to print a new menu. Maybe you will now with digital menus, then it's easier to change the price. But sort of historically, a lot of prices, when I sign a contract with an employer and they tell me they're going to pay me something, that doesn't get changed every second. If you have a menu in a restaurant with some prices printed on, it doesn't get changed every second. So some of those actions take a while to really, ripple through the economy,
go through the system. Yeah, and there's a lot of lagging data as well, so it takes some time to work its way to the economy. So obviously you had that big spike up with the oil prices, and then they've come down a little bit. They're starting to go back up again, but they come down a little bit. And then also shelter seems to have spiked up quite a bit recently, so accommodation, and you would think naturally as the interest rates increase, that there should be more difficulties, people paying their mortgages, etc., and there may be a price coming down in accommodation, but we will see. And Heloise, anything that you kind of noticed from the last quarter, and anything that you think is kind of key driving the performance of what happened in the last quarter?
Yeah, I mean, I think there's everything that Jeppe has covered is obviously very valid. And I can only build on that because what both of you have said is sort of what's echoed in my review of the quarter, this last quarter. And that's that when there is inflation, we almost expect this lag in the prices. But because it's been such a long time since a lot of the developed countries have seen inflation, there's almost been an overcompensation for it. So this effect that Jeppe is talking about of every second, because there's this high level, at least we're seeing prices going up more than inflation, especially with what you're saying with housing and things like that. So the prices are almost overcompensating for the uncertainty and the inflation. And so this turbulence is really even more driven by the sort of perception, both of the expected and the real interest rate rises. And that's a really weird place for the economy to be, because we should be driven by the numbers, we should be driven by the facts, but we're seeing a shift towards being way more sort of emotionally driven at this point. For my portfolio specifically, I used to be a US tech heavy portfolio that sort of diversified away from tech during the pandemic, and then earlier this year went a lot more heavy for UK and Europe-based stocks. UK specifically because it's high dividend yield paying companies, a lot of large companies. So I thought that was a kind of safe safer place. The UK also doesn't have a large tech sector, so I thought it would be less volatile. And up until like Q2, it's really held up fairly well compared to some of like what was happening in the US. But this quarter, we really saw UK equities falling strongly as well, and that's largely because of what's happening locally with the politics. We had a new prime minister come into play. We had the mini budget, which wasn't well received by the markets at all, and that sent the sterling to an all-time low compared to the US dollar. And then the same, I have a bigger exposure to the Eurozone, and that also experienced such sharp falls because of the ongoing energy crisis. So a lot of hyper-localized things, as well as these sort of global things going on, and I would say there's really no sector that has been spared this quarter.
Yeah, it's very difficult to find safe havens at the moment, right? Because traditionally a lot of people would go to bonds, but bonds are far from safe at the moment.
Yeah, I would almost say the only thing that has sort of not been the saving grace, but has been the small beacon of light, not that it's a very bright beacon, is, Bitcoin managed to hold some of its ground in Q3. And even just by posting like a neutral performance, despite the overwhelmingly negative sentiment in the rest of the traditional markets. So that's a slight beacon of hope, not a very big one. So yeah.
And in terms of inflation, because I think at the moment it's basically like it's a race between I think it's a race between bringing down inflation and making sure that the Fed don't break anything, right? Anything that can materially hurt the market kind of long term. And the Fed's mandate has always been to try and get inflation down to 2%, right? I think we can all agree that it's pretty unlikely in the near future that they're going to be able to do that. I just wanted to get some of the panel's views, really. What do you think would be kind of acceptable if you were kind of in the Fed's mindset? What do you think is acceptable in terms of inflation before they might consider a pivot or to reduce the interest rates? What do you think is stomachable? Amar, do you have any views on that?
I don't know. I mean, maybe 5% would be something that's more tolerable, I think. But I'm not so sure if it's the number. I think with the midterm elections coming up in the US, I think that would be a big factor in determining the interest rate policy. This was the last CPI print before the midterm, so it shows that the interest rates that have risen so far haven't really stopped inflation. So maybe a voter would think that this is not the right policy to do, and maybe I should vote for some other politician instead of those who are in charge right now. So if we see a big change in the US in terms of the party running the government, I think that might signal a change in interest rate policy as well. So if that happens, I think we could see a strong market recovery in the later part of the year.
Yeah, it's definitely very affected by interest rates. I think the midterms are going to play a big role in it because there's going to be a lot of pressure. The Fed are supposed to be independent, but we all know that they obviously have pressure from the administration. When the economy is roaring, presidents tend to do a lot better in those kind of midterms. Jeppe, any thoughts on that, on what you think might be acceptable in terms of inflation and might kind of signal a potential change in interest rate policy?
Yeah, I think so. There's a module in my models that I called Jerome Powell's legacy. And so that's basically based on if he wants to leave a good legacy, what's the maximum he can do to stimulate the economy. And I think that is to end up with a total inflation through his period of about, less than 2.5%, because then mentally you'll sort of round it down to 2%. So if you, there was a lot of, when he sort of, from the beginning of his period, there was a lot of leeway created by having less than 2% inflation. And that's sort of been burned through now. And then the quicker it can come down to less than 2%, the quicker it can the more he can try to turn in the target. And I think to maintain that legacy, he has to be extremely aggressive. And now he is being extremely aggressive. And then that's I think what that's what's in the end gonna drive his behavior, and yeah, then we'll have this sort of 75 basis points, 50 basis points, and then maybe be done with it. And because of the reduction in the balance sheet and the bank's loans out, we'll see a sort of eventually quite a significant deceleration of the inflation. And then that's going to be really tough for the economy, for countries abroad as well, with a strong US dollars. And yeah, I think that's the baseline. And then of course things can sort of go a lot higher than that or lower than that based on various factors. But that's my baseline.
How do you think that the strengthening of the dollar is going? What effects do you think that will have, kind of longer term, on the markets? And do you think it's going to be a long term effect or more short term effects? Heloise, do you have a view on the strengthening of the dollar?
Yeah, I mean, if we're considering why the dollar is strengthening, it can help us understand how long it might last and what the effects of that will be. I think, unfortunately, we understand some of the reason for why it's strengthening, but not all of it. So ideally, it should not be long-lived. We should see this only for a short period, but I'm not sure how this, and this probably links back to our discussion about inflation and all the midterms coming up. In the UK, we have elections coming up, so yeah, I'm not really sure if it's easy to predict how long it'll be around. Just as you said earlier, bonds should have been a safe haven, but we're not quite seeing that at the minute. So yeah, don't know if there's any clear answer to that.
I do think so. And I think obviously it's very tough on other countries as well, right? When the dollar is strengthening, for those who are transacting in dollars and they have to buy things, etc. It can be quite difficult for international companies.
Yeah, I think it definitely starts to affect the countries that are with better capitalized banking systems that finance a lot of the credit to a large degree by their deposits will be less vulnerable to this effect. And I mean, that's always been the case. Even with inflation and recession, the poor always get hit a lot harder, and in this case we'll see the same for countries that have weaker currencies to begin with. They'll definitely feel the effects of the strengthening dollar a lot more than some other countries might.
And Jeppe, have you noticed any companies in your portfolio from, I don't know, listening to earnings calls and other things? Have you heard a lot of those companies in your portfolio talking about the effect of the strengthening of the dollar about their long-term businesses?
It's so some companies, they hedge a little bit of their currency exposure continuously, so they're always a little bit less affected. Then you get the sort of always if you have a higher valuation of a currency in one country, maybe that'll change a bit what you want to import or export, or how competitive your product will be if you don't change your pricing. But you can sort of adjust on that. If you say like, my price for my product is $99 and now the dollar's worth a lot more, so in other currencies my product's now more expensive, yeah, but then give a discount. Like, how big a problem is that really? You can just say like, okay, now my product is 10% more expensive, so I'm going to give a 10% discount. So it's sort of the same. And it can be more difficult to do that with employees and others that don't understand that so well necessarily, but that's sort of extremely manageable. The only ones that are sort of having an issue that's not manageable is people that have their debt denominated in US dollars and they have their income in another currency, and now they got to be paying those interest payments in US dollars. There's no way around that. That's just a loss you have to take like that. And for some countries, some companies, some people that have set themselves up with a too large liability in terms of US dollars, they're just feeling the pain of that right now. And it could very well be that, because it's not always obligatory to write that out in your financial statements. It's not always that sometimes people can do a very convoluted way of really showcasing how they are exposed. And so there's sort of that old saying, it's only when the bath water goes out that you see who's been swimming naked. So there can be sometimes where it's like, actually they borrowed a lot more in US dollars than had been thought, and now it's suddenly being realized that they have to pay more than they really thought they would have to. And then it's just, but then sort of, usually you have some you can roll over different kinds of debt. You can live with a certain amount of punishment. It's really only for those companies that I luckily don't have any of, not luckily, but I don't have any of those in the portfolio that have way too much debt compared to sort of what they're capable of paying down. But some of those companies may potentially be worth giving an extra look over their liabilities, where if it's a company owes a little bit of money and it's in one type of loan or another, you might not care, but in this case you might certainly care a lot. Also, can I add one thing?
Of course you can.
I think it's very important for people also, when they're looking at the returns in the portfolio, they understand how much of that's been driven by the increase in the value of the US dollar. If the US dollars increased by 10% and a stock portfolio declined by 10%, but your portfolio is in dollars and you're living in the UK, in GBP, you are equally well off. Now, so sort of many people that are seeing that they've lost 20%, but actually it's in 10% more valuable dollars, they really only lost 10%. So quite often when you see sort of new records set for commodities, for instance, as well, it's really half of that's explained by just the fact that the dollar's worth more. So your commodity is worth, less US dollars, but those US dollars are worth more.
Yeah, that's a very good point, and it's often an aspect that a lot of investors overlook. And does anyone have any views on the kind of bond market? Because we saw what's happened in terms of obviously the Bank of England and the UK. We've seen that the UK government the Bank of England have had to buy bonds, or gilts as they're called in the UK, in order to potentially stop the pensions going out of business and having liquidity problems. First of all, does anyone have any views on that? But also, does anyone anticipate that there could be future problems with US bonds? Jeppe?
Yeah, so I think there's certainly bonds are not interesting yet, but they're getting a lot more interesting. And it's especially in terms of percentages. If you're looking at making, 0% on an inflation protected bond, that's maybe very uninteresting. When it suddenly goes to 1%, from 0 to 1, that's a very big difference. If you got a small family fortune and you're making 1% off of that, you can survive. Now, if it goes from 1% to 2%, wow, you just doubled your passive income from that. Now, from 2% to 3%, that's a 50% higher passive income off of that. So when you're going from next to nothing to something, in terms of how much you're actually increasing your passive income of that, is really, really amazing. And once you start to get to that, like 4 or 5%, then it becomes really interesting, because that's at the point where you're like, I'd rather have a safe, if I'm taking a nice big UK company that like Vodafone Group, I can make something like 4 or 5% fixed from them, compared to something, like a 7% expected in return on their stock. I'll be like, at some point, I'd rather have the, the extra protection that bondholders get paid first. There's if it's next to nothing you're getting compared to, then you'd rather take the risk. But there is a certain meeting point there where bonds come in. I used to have bonds. I haven't had bonds in a long time in the portfolio, but at a certain interest rate, it's certainly something where I would say, okay, at this interest rate, I like this bond.
So you're starting, even though you're not there yet, they're starting to become more attractive to you, and you're thinking about.
On this side of the screen, I got the stocks. On this side, I got the bonds. So they're sort of for a while, I haven't had the bonds. They've been sort of I don't know, had to click alt tab a few times to get to the bonds.
If we talk a little bit about portfolio construction and what people were kind of doing in the last couple of quarters, Amar, are you still quite bullish on tech stocks at this current time? And how do you feel about the valuations now compared to what they were before? And do you think that they're in general at a good valuation at the moment?
Yeah, I mean, let's just put some perspective on this. I think just 1 year ago, the market was at an all-time high. So, I mean, 1 year ago, the world looked very different. Everyone was happy with their stock market performance. Now we're in historic times. I think the S&P 500 is down 25%. It's not down 25% very often. The 𝗃𝗃𝗃 is down 36%. So that doesn't happen very often also. But when it does happen, it can be a very good buying opportunity. I mean, if you have bought every 25% dip in the S&P 500 in the past, you have made a lot of money today. So I think we got to keep that perspective. Let's see 1 year from now. I think, again, things will be very different, probably much more positive, I think. I don't think inflation is going to be something that's going to be very persistent for a long period of time. There are people like Cathie Wood who have a different opinion on inflation. She says deflation is probably a more major threat and a recession is a more major threat. So these are things we need to be careful of if we keep, raising interest rates. So I think those things will be taken note of.
Yeah.
I think, my portfolio hasn't really changed in the past year. I'm still very heavy in a lot of tech companies, as you pointed out. But I think these companies are very strong. They have cash. They're cash rich. Google has $100 billion. Facebook has $40 billion. And with the dollar so strong, they can do a lot more with their dollars overseas. So they can buy more data centers and they can expand their products in other countries. So if you take a long-term perspective, these cash-rich companies can get stronger in times like this.
Yeah. Okay. Thanks, Emma. And I think that's a good point as well you made about inflation, because I think people just tend to think inflation's could go up to a peak, and then it will start to come down in a slow kind of manner. But I think if we look at like what's happened in the economy over the real long term, and all the different cycles that happen, I think inflation can go up, and it can go up and down. It doesn't necessarily have to follow the same pattern. So I think after a period of time, inflation may go down, but it could start to peak up again at any point, depending on what they put in place in terms of monetary policy. What about you, Heloise? How have you kind of set up your portfolio? Are you still quite heavy tech stocks? Just give me a flavor of what you've been doing.
Yeah, so of course, my portfolio used to be very tech heavy a year ago. I'd say in the last 6 months, I have sort of diverted that away from tech. One is if we look at the definition of tech and the companies that we would include in the traditional tech sector, I think we're starting to see a lot more sort of integration of tech into different sectors, which is blurring that sort of line of what we call tech and what we don't. But definitely the objective of the game has changed a bit. As Amar said, a year ago, everybody was quite happy, economies were growing, and so were our portfolios. Of course, if we're in a bear market like we currently are, the objective is really just about protecting the capital and trying to get to a neutral stance. And so that's been the objective of my portfolio over the last 6 months. And that means diversifying away from pure tech stocks, diversifying away from the US, and just trying to be a little bit more prepared for the uncertain future that we're seeing at the moment.
Okay. And have you kept some cash on the sideline for like any opportunities that kind of come up during this time?
Yeah, I have. So I have a pretty large cash buffer in my portfolio at the moment, which is between 20 and 40% on any given day. So I'm sort of using that cash buffer for any short-term opportunities that I see in a weekly basis. I'm not really a day trader. And then of course it's difficult to tell when it's bottom out, but at some point you'll want to be ready to go in with as much cash as possible for where the market is right now.
And Jeppe, any kind of changes in your portfolio more recently because of the economic conditions, or have you kept it a similar strategy to how you always had?
So going into COVID, I had a lot more of the work from home stocks. That proved to be right. And through the whole sort of long bull phase, I've had equivalent returns of ARK and higher than NASDAQ and so forth. But in the downturn, I've only had declines of S&P. And that's because I moved much more into value and especially got rid of all of the ones that were, I would say, high growth companies, but without a proven business model, but with certainly so low profits that it's hardly a business model. It's a survival model, not really a business model. Is a way to make positive cash flows. Maybe not. If a company is there's different ways of accounting for growth. Some costs are really investments. Some investments are really costs. And sometimes you can capitalize an IT project, but I know that IT project is going to need to be repeated after 3 years and then repeated after 3 years. So I know that capital expenditure is not really capital expenditure; it's really a recurring cost. Now there are other things where I know that this might be counted as a marketing cost, but this is actually something that's doing so well for the brand. This campaign is setting up this brand forever in people's mind, that this is not just a one-off cost. This campaign is so good that this is gonna, you know, deliver sales value for the rest of my lifetime for this company. So sort of when taking that into account, there are some companies that I think have a good long-term profitable business model, and those I've kept. The ones without that left the portfolio in that time. And in this year, the one that's really sort of taken up a largest in the portfolio is the metals and mining companies, which I think it's not because I believe in them in the short term or the medium term. I believe in them for the long term, but I believe that sometimes the long term comes very quickly. So if I analyze that these are things that we are really, really going to need, and unless we really pick up, you know, maybe I'll get more in on that in the end when we talk about different industries, but that's certainly one that's taken up a lot larger share of my portfolio in the last year and last quarter.
Yeah. And obviously at times where there's the deepest pain, you often have the most opportunity as well, right? I wanted to move on and talk a little bit about crypto as well, because crypto has had a very difficult year in 2022. In 2020 and 2021, we saw the rise of Bitcoin and other cryptocurrencies. And it's been kind of caught up in 2022 in the drawdowns of obviously what's happening in stocks, but cryptocurrencies been dramatically affected. What are your views at the moment on crypto, Heloise? I'm not going to ask you if you think that they bottomed, but do you think a lot of the pain is kind of out of the way, and do you think we're seeing some quite good opportunities at the moment, a year after the decline of cryptocurrency prices?
Yeah, I mean, it's certainly been quite a volatile ride for crypto. I have always been quite fortunate in bringing crypto in and out of the portfolio at good times. But this time I sort of missed the upcoming bear market, or the crypto winter, whatever you want to call it. But the crypto market has always had this very peculiar asymmetry to the financial markets, and so it's always been quite a useful tool in any portfolio. So if we look at the crypto market sort of going forward, a bull market usually ends up in this really extreme euphoria, which is often like the short-lived parabolic surges in the prices, which is exactly what we've seen in both the crypto and the stock market. And then in contrast to that, bear markets tend to be a lot longer, more painful, as you rightfully say, and they often leave us in this deep states of sort of real fear and despair. It's a very weird psychological state that persists often for months, that it even becomes the new normal. And so they're slow and systemic to get out of them, but both of those have one thing in common, and that's that they have absolute peaks and absolute bottoms. So in terms of, do I think that all the pain of crypto is over? I think we do have some more pain coming in Q4. But I am very optimistic going into Q1 for 2023 that we may see a new bull run, and that's just because of this asymmetry that we've had previously. Of course, there's a lot that still has to happen with the regulation around crypto to make it a sort of more valuable asset class, but all of that is starting to happen, and with the pandemic or other factors have sort of sped that along. Is quite optimistic for anybody that still has crypto in their portfolio at this time, for those who've held on.
The long-term hodlers.
Yeah.
I think you're right. I think there's obviously this euphoria in the bull markets, and there's the opposite doom and gloom in the crypto winter. I do think that it gives a good opportunity for really good projects to build during. They kind of take away the noise that's happening in those bull markets where everybody's speculating on the markets, etc., and it gives them an opportunity to build the products and the services that are going to be part of the new bull cycle when it comes back around. So I think there's a good opportunity to build there as well. Yeah,
absolutely. And that's such an important point, because cryptocurrency was essentially introduced to the mass market as a currency, because that's something that people could understand. But crypto in general has so much more potential if you just consider the blockchain. And so it gives opportunity, like you rightly say, for a lot of those other projects to come into the market and become more widely accessible. I don't know if they'll be well understood, but yeah, it's definitely a good time to be building them out.
Yeah, I think it is positive signs that especially Bitcoin has held up so well over the last 2 months, 3 months, despite you know, stocks hitting 52-week lows. It's been in the range of 18,000 to 24,000 for the last kind of, I think it's the last 160 days or something, 150 days. So I think that's some positive signs that could be holding up. Jeppe, do you see any kind of catalysts on horizon, you think, for crypto? Not necessarily, I'm not necessarily talking about going back up to all-time highs. I think we all know that the crypto market is cyclical. However, do you see some positive signs of a potential bounce off the lows for Bitcoin and crypto in general?
So the price of many of them is dependent on, you know, what people think and what people think other people think and the hype and whatnot. But I think fundamentally blockchain is a terrible technology. I don't think it has long-term potential. And I think that's an underlying killer from the vast majority of crypto projects. I think that there's potential to change, you know, do private currencies in the future on other technology. That's going to be very interesting, but that's not where we are now. I think in the same way that I don't like to hold lots of cash, I don't like to hold lots of cryptocurrency, but I like to hold a little bit of cash because I need liquidity. I need cash to be able to buy things. And I think that there is a potential for the long term for a cryptocurrency or a few to fill up that role. And for that, I might hold a little bit of cryptocurrency for the long term. I currently have a little bit of Bitcoin, and I think that serves a quite nice role in the portfolio. But there needs to be a sort of a second layer technology on Bitcoin, or proof of stake needs to turn out really, really well for Ethereum, or there needs to be something that takes this to the level where it's not just sort of a, here is a dead weight currency in my portfolio, but something that's an actual sort of long-term investment object to make it interesting. And I think a blockchain like stone tablets, couldn't compete with paper. I don't think blockchain can compete with other better database technologies. So it's fortunately, it's got like a great brand. Everybody thinks like, oh, I'm going to do a blockchain for this, a blockchain for that. And they somehow think that makes it better, but it doesn't. It suffers from all the other problems for how you sort of have a balance of powers in controlling things, whether you have governance over a company, a government's governance over a country, or, you know, how you decide to manage your flat. If you have 3 flatmates and you put a piece of paper on your fridge, you know, you can use whatever technology you want for that. You run into a lot of the same issues. And the only reason that people think that blockchains magically made any of those issues disappear is just because they haven't really thought about how governance works.
You have some Bitcoin in your portfolio, right? Do you have that in there kind of more for its kind of store of value properties? What's the reason why you have Bitcoin in your portfolio?
I think there is this, if Bitcoin is the new gold, then Bitcoin's price will drop by more than half. As the new gold, it's not supremely valuable asset. Bitcoin has to become something that you will use for payments. Otherwise, it will not sort of, it doesn't really have that. If Bitcoin needs to reach $100,000 in the long term, there's sort of 2 sides it can get to that point. One is the side of the dollar just dropping massively. If people completely lose faith in our fiat monetary system and dollars just lose all value, then anything will become, you know, very valuable when measured in dollars. Because, you know, in the same way that when the Reichsmark in the old Germany went, you know, lost all of its value, of course, everything when then measured in that currency becomes incredibly valuable. But that's sort of the uninteresting road. The interesting road to a very high price for Bitcoin is that there is a second layer technology that makes it something that you will use whenever you're buying something, that you get your salary paid out in this, you'll buy things in the supermarket with this, you'll order things on, you know, whichever online app you like to use to buy things for. If you can get to that stage, then it can become very, very valuable. Then it can sort of, you know, start replacing major global currencies. And that's a much more interesting space.
I think that if we talk about just the currency aspect of crypto, we're missing the whole point of it. Yeah, Jeppe just dismissed like blockchain. And I think I don't think we may never get to the point where crypto is a widespread currency, and that's not its major use case for me from a purely like technological perspective. It's more about the other things that it's able to do on the ledger. For example, if it's able to simplify legal transactions in the UK, if it's able to make those more fairer, more equitable, and more transparent. I think that's really where the value of cryptocurrency comes in, but that's perhaps a larger debate into its value. I think using it as a currency is just a nice use case to introduce it to the general public.
Yeah, I agree with that. I think potentially in the long term, I'm talking long term out, potentially it could be used as a currency. I also agree it's not the main use case. I think there's a lots of really good use cases that are kind of going on at the moment, and some things will work and some things won't work. But we've seen the kind of rise of decentralized finance, DeFi, which is I think is a really good initiative, because it's the first time that you've kind of been able to decentralize finance, which is traditionally kind of run by banks and major investment firms. So I think there's a lot of opportunities in there. Gaming, as you said, smart contracts is a big innovation as well, which could change things and the evolution of how business is done over time. So I agree with you, Heloise. I think there is a lot of use cases, but again, there will be a lot of stuff that just won't work, that they'll say, okay, we should put that on the blockchain, and it doesn't need to be on the blockchain, right? I think there will be cases of that, and there will be projects that that never needed a token in the first place, and didn't need to be on the blockchain in the first place, and they will fail. But I think that there'll be a lot of testing out of different applications, and some will flourish, some will fail, but I think dismissing blockchain long term would be a mistake, I think. Amar, do you have any views on crypto?
What I'm seeing more nowadays is the development of what we call Web3. So this seems to be the evolution of crypto. So I think there will be some innovation there. Maybe we'll see a Google kind of company come out of Web3, you know, more decentralized, perhaps based on blockchain. I know blockchain has a lot of flaws, but I see that it also has some benefits. I think Bitcoin has never been hacked, as far as I know, but Google and Facebook and all these big tech companies have had you know, those kind of cybersecurity issues. So there's some merit in blockchain. Yeah, what I like about crypto is about the decentralization. I think some parts of the thesis were broken when Bitcoin didn't really hold up as an inflation hedge. But I think what Jeppe said about, you know, having another layer on top of the base layer, like what Ethereum is basically doing, I think we can see a lot of progress there. So Ethereum is my favorite way of holding crypto. I wouldn't personally hold Bitcoin, but I do invest in Square. Square is also very big on Bitcoin. It's run by Jack Dorsey. So I think that's a good alternative way to play Bitcoin. I'm still very apprehensive about the carbon footprint of Bitcoin, especially when energy prices are so high nowadays. It seems like a little waste, in my opinion.
Yeah.
I don't know, maybe Elon Musk will put Twitter on blockchain one day, you know, so that could happen also.
Yeah, as long as he doesn't put it in Dogecoin. Yeah. Actually, it's quite interesting you said that Bitcoin didn't hold up as a store of value. And obviously you can see what's obviously happened in the price this year. But I was looking at a really interesting chart a few months ago, which showed the Bitcoin price over the last, 10 years, 11 years, and plotted that against the M2 money supply. So obviously the new money that's being printed into the economy over time. And actually, it actually follows the correlation between the rise in Bitcoin prices and the increase in M2 money supply is very correlated. So I think a lot of the argument is that Bitcoin is a store of value, but I think that it actually does correlate a lot to the M2 supply. And obviously we've seen reductions in the balance sheets, etc., and the rise of interest rates. So it hasn't been a very good environment for Bitcoin. But we do know that the governments over the long term like to print money. Also, I was thinking that with a lot of the weaknesses in the other currencies, you know, like the pound has dropped quite significantly this year. And the Japanese yen, the euro's not done particularly well. And I'm wondering if we will see quite a lot of inflows into Bitcoin, for example, where people are, you know, worried about holding their money in pounds, holding their money in euros, for example, and yen, and whether they'll start putting their money into Bitcoin as a future store of value or increasing in price over time. Any views on that, Heloise? Do you think that possibly might happen?
Yeah, I mean, as a South African, we've definitely seen a lot more trust in cryptocurrencies in a lot of African markets for a lot of dynamics, purely because people in developing countries tend to have a much higher mistrust for governments. They are forced to be a lot more self-sustainable. So just in the last year, you know, significant proportions of Kenya, South Africa, and Nigeria's populations are already using digital currencies. It's close to 10% in all of these countries. So I definitely don't see why those, in terms of that, I mean, I think developing countries are a bit ahead in their preparation for inflation. They've never not had inflation of less than 2%, and so these markets are a bit more prepared and resilient in that way. And so I can definitely see how some of the emotional aspect of putting money in cryptocurrency can catch up in developed markets as, you know, currency become more unstable. Yeah, I can definitely see that happening.
Yeah, I think it's quite easy to see it from a kind of Western perspective sometimes, where you look at kind of currencies that have traditionally been quite stable. I know recently less stable, but I think there's probably quite a lot of use cases in terms of store of value, etc., for countries that have been plagued with inflation issues throughout the years. I really hope that during this bear market that a lot of the regulation will be pushed through over the next kind of year or two, because I think it's going to require a lot more kind of clarity over the regulations before the major hedge funds, money managers, pension funds, sovereign wealth funds are willing to step into this, because they're going to want to make sure that it's completely regulated before they make any such investments. All right, excellent roundup on crypto. Just to end things, I wanted to do a really interesting discussion with you all and just come up with kind of one key sector that you're bullish about over the next 6 months, and just explain your kind of thesis behind that. That would be really great. Jeppe, can I start with you?
Yes, so I think the most interesting one is mining and metals. I think if you look at how much of different kinds of metals we are going to need over the long term, and the total amount we can expand our mines, the total amount of exploration going on and so forth, we are in dire need. We are in short supply of many. Some of the increasing demand can be met by increased recycling. Maybe we'll start mining the seabeds. Maybe we'll find asteroid mining or something. But failing that, I think we are long term looking at an extremely short supply compared to the demand, and these companies are trading at extremely low prices. So you're locking in ownership of something that's going to be really necessary in the future by buying these now. And so that's what I've loaded up on a lot over the last year, and that's a part of been very happy to be able to load up on that at these prices. Yeah,
and you're quite happy with the valuations in the mining companies at the moment, and you plan to hold longer term, yeah?
I'm extremely happy with them. Whenever I invest in a company, it's because I want to own these assets at that price.
Yeah.
So I can't say if it's going to be a long term or not. I'm very happy with what the price is compared to the value right now. But it could very well be that everybody starts to make the same analysis, comes to the same conclusions, or do something else in the future, and then you know, what I thought was a long-term investment suddenly becomes a short-term investment. But at the moment, I very much like the long-term value of these compared to the current price.
Okay, all right, that's great. Thanks, Jeppe. 𝗲𝗲, do you want to go on to your key sector and what you want to run through?
Yeah. I thought of mining companies as well. I think copper has dropped quite a bit, so that made the mining companies more enticing. But I settled on semiconductors instead. The reason is because I think they have more tailwinds behind them. So, you know, a company like Micron, it produces chips, and these chips go into a lot of different products. So, you know, 5G is one of the tailwinds. AI is another tailwind, artificial intelligence, autonomous driving, that's another tailwind, Internet of Things, the general digitalization of, you know, the world, and then electrification. I think that's another tailwind. You know, a lot of things are going into the direction of renewable. So if you build a renewable plant, you need chips as well. So I think semiconductors, they seem to have bottomed over the last few weeks. I mean, a lot of semiconductor companies have seen a decline in revenue as well. So that shows that the economy is not as strong as it was before. But I think in the coming months, you know, I think some of these semiconductor companies can rebound strongly. One name I'm looking at is Micron. I haven't added it to my portfolio yet, but it seems to be trading at a very low PE. What I've added to my portfolio so far is the ETF, because I haven't settled on any particular semiconductor name yet. So the ETF is SOXX. I also have some Intel in my portfolio. I think Intel, besides being a play on semiconductors, can also be a turnaround play. So that's another reason why I have Intel.
Okay, thanks, 𝗲𝗲. And over to you, Heloise. What's your sector?
Yeah, I think my sector is a bit like Jeppe's for different hypotheses, but I would probably extend it. I would say materials. So those companies providing steel, wood, plastic, building blocks, all of those. And the main reason for that is if we sort of look at, you know, we talked a lot about inflation and recession today. All of us are sort of choosing industries that will benefit in the recovery. It's sort of too late to try and pick something that's going to do well in the recession, right? So if we're talking about the recovery, we need to consider what sort of recession we think we're having right now.
Yeah.
And in that case, I would say that we're looking at an L-shaped recession where we're seeing a bit more longer periods of recovery. Our last example of this was the Great Depression. Fingers crossed we won't be stretching it out that far. But what sort of happens in these L-shaped recessions is that businesses and individuals are placed under stress for a lot longer. So you see this first hit of inflation and recession, and that's where the sort of essentials tend to do well and hold up well. But as the recession continues to hold, people are delaying buying bigger ticket items. They're holding off on things like repairing or renovating or maintaining their homes, their vehicles or their gardens. And so that's really pushing that into the early recovery. So even though materials wouldn't be something that you would usually sort of associate with a recession, I think it's quite a high quality asset for the future growth as we're coming out of the recession.
I think you're right. I think people are more likely to delay the kind of long-term building projects and concentrate a lot more on kind of repairs, maintenance, etc., which could be good for the materials sector. Yeah, excellent. Thank you very much. I'm just going to run through my one now, my key sector that I wanted to talk about, and that is nuclear energy, and that is a sector that I'm quite bullish on at the moment. It's extremely hard to time because it's a lot of it is caught up in what's happening in the political environment. There's a lot of kind of red tape around it. But historically, the nuclear market has kind of lagged for quite a long time. There was a lot of enthusiasm about nuclear in the early days before they had some of these big disasters like Fukushima and some other big disasters that happened, and that kind of really turned like a negative sentiment on the uranium industry as a whole and uranium as an energy source. However, I do think that with what's happening in the current environment, if we look at the dependence that people have on Russian oil and gas, I think that governments are starting to wake up a lot more to the potential of nuclear. And we've seen some nuclear reactors come back online in Japan, in France, and some other countries as well. And I think that there is likely to be an energy shortage in the winter, especially in Europe. And I think that this could provide good tailwinds for energy. I think that renewable energy, I think a lot of people are looking over to renewable energy, such as, you know, wind turbines and other type and solar, etc. But I think there are gaps, and it is quite difficult for you to be able to have a sustained amount of energy that you use for renewables and not to have those gaps. And I think that nuclear will become more and more used by the governments in order to be able to stop some of this energy shortfall. And I expect some tailwinds. There's not a lot of great options on eToro in terms of nuclear investment companies to invest in specifically. I think Cameco's on there, but there is a uranium ETF, Ura, which I'm invested in my portfolio. So I'd say I'm pretty bullish on that, but with the caveat that there are quite a lot of political issues attached to it, and that timing it can be extremely difficult because of those political issues. Okay, so shall I wrap up there? Thank you very much to all the panelists today. I think we had some really great discussions and we tackled a lot of topics and squeezed in quite a lot into a fairly short period of time. Thank you very much for all joining, and we hope to see you back again soon. Thank you very much.
Thank you very much, Stephen. Thank you very much, everyone.
Thanks.
Yeah, thanks for having us. It was great chat. Thanks, everyone.